I've got a management company, they do all the negotiations. I've never even met my tenants. All I know is I know their name and I get a check every month. It's a $400,000 house and I'm getting $3,000 per month in rent. What I did was 10%. So it was a $430,000 house. I ended up negotiating it down to $415,000 and then I ended up putting $40,000 into the house.
My friend Park Brady, real estate developer, is here to share with you how to make money with rental properties. The reason I'm interested in real estate is because, one, it satisfies what humans need, shelter. That's really important, never going away. Number two, real estate presents an opportunity to invest in a productive asset, meaning it appreciates in value over time and it also pays you in dividends, cash flow, passive income. Everyone's interested in that. So Park, why don't you start off by saying, why did you decide to dedicate your career to real estate?
Yeah, well, thanks for having me, Trent. I think from a real estate standpoint, it was really important for me. My dad and my family has always been in real estate, and I wanted to, do something that could positively impact the community, have some effect on, placemaking and being an attraction where people want to come. So for me, real estate was always something that I wanted to do.
Fantastic. Well, what everyone's here wants to know is how to make money with real estate. I see it a lot on the internet and they say, go buy a rental property, go buy an apartment complex, go do Airbnb, whatever it may be. There's a lot of different ways to make money in it. You have actually purchased a property with your own money and you are making money today. So why don't you start out by sharing why you decided to buy a rental property?
Yeah, I was looking at a lot of different investment vehicles in real estate. I was thinking of, there's these crowdfunding sources I think that you've been involved in. But for me, from a real estate standpoint, I wanted to have something that was quick on income, that I could get into relatively easily and not have to have a lot of overhead or a lot of time spent managing the property. And so for me, it came down to either vacation rentals or long-term rentals. And long-term rentals are a lot easier. There's not as much furniture expense. There's not as much turnover. A lot less damage happens to the property because you've got one tenant. You're not kind of dealing with people coming in and out. And so for me, that was really attractive. And then I wanted to, test out the waters. And so I bought my first home back in October 2021 in Georgia. What I think was really important in that was the management company, because I'm not there. I'm not going to be on site. I'm not going to be able to, handle their requests. And so I hired a management company. They're taking 11%, which I think is pretty fair. In vacation rentals, it can be anywhere from 20 to 40%. And so hired a management company. And when I was looking at the house, I was looking at kind of the market, and specifically in the market, what does the supply look like? What does the demand look like? Right now, single family homes, especially with how interest rates have gone up, are hard to buy. There's not a lot of first time movers or buyers that are moving into single family homes and owning them anymore. And so I think that from a rent growth perspective and a supply perspective in Georgia, where I bought it in St. Simons, it was a good fit. And kind of when I'm looking at a real estate investment or a real estate home to purchase, I'm looking at anywhere from a returns perspective or an IRR perspective over the lifetime of me holding the asset.
And what is IRR, for those who don't know?
Yeah, it's internal return on investment.
And what exactly does that mean?
Or internal rate of return, and essentially what that means, it's measuring your cash flow. And so, it's looking at what your cash flow is and then what your ultimate exit is, and measuring return over that period.
So how much money you're getting paid from the tenant versus how much money you are paying in expenses to the property company, to the mortgage, to property taxes, et cetera, et cetera?
Yeah, exactly. And what I'm looking for on that is about 15 to 18%. Well, really anything over 15%.
And is that taking into account selling the property one day?
Yeah, it does.
Okay, so the actual money you anticipate you'll be able to sell the property for in 5, 10 years.
Yeah, and the way I modeled it was I modeled it holding it for 7 years. I don't know if that's how long I'll hold it, but for me personally up front, it was let's hold it for 7 years. Let's see what the cash flow is. Net cash flow. So, you're taking out expenses, you're taking out everything in terms of, and this is unlevered or levered IRR. So I'm taking out, my mortgage expense and everything.
So
like
using
well.
debt, so money that's not yours to then use money from the bank through different people to then use that to actually make more money.
Yeah, exactly.
And is the rhyme and reason behind 7 years, is that just a rule of thumb of it may not be the best time or the worst time to buy a house, but if I hold for 7 years, it's probably going to go up over time. Is that the thinking behind it? Because I think a lot of people look at the market and they say, well, it's so expensive, I can't afford it. But if I wait, it's going to be too expensive. I'm never going to be able to buy it. But then some people say, well, I'll wait because it'll probably go down. And nobody can really time the market. So is the rule of thumb holding for long term just, it will all be good through all cycles?
Yeah, and I think from a holding for a long-term perspective, I mean, with single-family homes, the way you're renting them, or the way at least I'm structuring, is 12-month leases. And you want to be in that house long enough to really see appreciation on the asset, and you can get a lot of benefit from the depreciating of taxes and of the value of the house on your taxes as well. And so I think that, you know, if you go in, you've got upfront closing costs as well. And so from a return perspective, if you're going to go in, buy the house, rent it for a year, and then sell it, you know, to get the return that you want to, you're going to have serious appreciation in that first 12 months on that home for you to get a return, because there's all sort of selling costs as well that you're paying brokers. You know, you're going to be paying taxes as well if you sell at a capital gains. And so you want to have enough appreciation. And so for me, you know, I was looking at the house appreciating 2 to 3% each year. Right now, it's been pretty absurd with single-family homes. I mean, they're going up 20, 25% each year. But I was looking at kind of standard time, standard, you know, appreciation of 2 to 3% each year. And then at that 7-year point is where the return made sense for me for sale. Now we'll see. My house is actually, since I bought it, it's gone up 25% in value.
Cha-ching.
And that's been 8 months. So I bought it at $400,000, and the house right next to me, which is the same exact house, same exact builder, just sold for $500,000. So that's kind of my benchmark, but that doesn't happen usually. This is kind of, I got lucky on timing.
So let's give everyone some perspective here. So we're mid-20s. We live in Dallas, Texas. He had been working at a large bank for a few years, so had some savings. Bought a home in Georgia. You talked about looking at a market that you know, that you can kind of get a sense of the supply and demand. And let's go back to the how-to. So let's say somebody is wondering, how much money do I actually need saved to put down for a down payment? How do I actually identify that property? How much money do I actually need to take from my bank account to pay versus using debt? So as you think about simplifying it and going back to square one, you identify the market you want to be in. You maybe see houses in a price range that you feel like you could do. What are those first few steps that we need to understand if we want to go from idea to actually execution, to getting the house?
Yeah, I think so. Let's just use my case for example. I think right now, with how competitive the market is, you want to be able to get pre-approved for a mortgage on whatever you're going for. You want to be able to close as soon as possible once you find that investment. And so going out there and just getting pre-approved for a mortgage, I think, is really important.
And how do you do that?
Yeah, I mean, just go to the bank. You know, apply, get pre-approved. You can go to any bank. You can do that online pretty simply. And it's a little bit different. You know, I would even call or try to get a contact at the bank and call if you know a local mortgage broker or, you know, lending officer at a bank, and ask them kind of what they're seeing, because usually when you structure it as an investment property, they're going to give you a little bit of a higher interest rate. But it makes sense. It's a little bit riskier. It's not your first residence. You know, you have to get a tenant in there before it's cash flowing, and so they're going to give you a little bit of a higher interest rate. So you want to be able to get pre-approved and understand that this is how much equity I have to put in, and this is what I can afford. What I did was 10%. So it was a $430,000 house. I ended up negotiating it down to $415,000, and then I ended up putting $40,000 into the house. And so, you know, I had gotten pre-approved, you know, negotiated that as well, so that I knew exactly what the interest rate I was going to be paying, how much I could afford. But then, you know, that's just the equity in the house that you're putting down. So let's say you're putting down $40,000. There's, you know, other things you want to be considering. There's closing costs with the bank. You know, there's origination fees. There's pulling title. There is, you know, legal fees. You're going to have a lawyer go through your loan documents and then ultimately close. You know, there's insurance on the house. There's property taxes on the house. Something I learned that I wasn't too familiar about was termite bonds. So when you're looking at, you know, a house, there's termite bonds you can get for 20 years, and it basically insures the house against termites. And You know, that's probably more prevalent with older houses. My house was built in 2014, but you know, I didn't want to deal with that. So I ended up getting a termite bond, which was about $1,200. So all in, I think, you know, I put $40,000 down in equity, and then my closing costs and everything after that ended up being around $47,000.
So you identified the house, you got pre-approved, and to give everyone context, I got pre-approved a few years ago, and it's actually way easier than it sounds.
Yeah, it's super easy.
It's way easier than it sounds. It probably would be helpful. Did you have a realtor to help facilitate the transaction?
So that's another good question, and I want to just jump back. So when you're looking at the house as well, you want to be looking at kind of what rental rates you can see in the market. There's a lot of different tools or apps you can use, but I would just go on Zillow and look at. You can go to there's a rent section or for rent. And then you can filter it down to, even if you're buying a townhome or a single family home, kind of whatever you're looking at, and see in that area what rental rates they're asking for. You want to be, historically it's been, you want to be around 1% of your purchase price. So, and the way that is if it's a $400,000 house, you want to be making $4,000 per month in rent. I would say that I'm less than that. So it's a $400,000 house, and I'm getting $3,000 per month in rent, and the returns still work. And so I think you kind of got to look at the certain situations. Maybe some places have lower property taxes or things like that, to where that 1% rule is just a guide, and then you can work from there and kind of build out the numbers. But yeah, I think. And then what was your question on? What was your other question?
Using a realtor?
Yeah, realtor. So I think that from a real estate perspective, it's always more beneficial to have your real estate license. So I have my real estate license, I have my brokerage license in Georgia, and so instead of, the seller usually will pay the brokerage fee, and so if they're selling the house at $400,000, they're going to be paying 6% of that, and then the buying broker and the selling broker will split that, so like 3% each. And so I was actually able to get that 3% because I represented myself as the buying broker, which even lowered my cost basis down on the house, by about $10,000.
That's creativity, guys, and yeah. It may seem overwhelming, so you may have to go back, rewatch this, take some notes, but these are the legitimate steps to do it. So you get the house, you close. How do you find the tenant?
Yeah, so for me, there's a lot of different ways to do it. You can manage the property yourself. I think when you do that, it becomes more of active income than passive income, because I think you're working a lot harder on the house. You have to be there to facilitate any tenant issues. You've got to be the one marketing the product, showing tenants the house and walking them through it. And so there's a lot of work that goes into just getting it leased up and then managing it. So I hired a management company. I pay them 11% of my gross earnings, so 11% on $3,000 per month. And so, model that out and see if it makes sense. For me, I'm in Dallas, Texas, so I can't manage the house. There's no way I would be able to actively market it. And so I've got a management company, they do all the negotiations. I've never even met my tenants. All I know is I know their name and I get a check every month. So it's pretty nice. And I just got paid last week for, July rent. And there was, in June, something wrong with a toilet or whatever it was, and the management company just fixed it. So they took $70 off it, and I never hear anything. It's actually very easy.
So I think a lot of people think passive income, and I want to do no work, I want to get paid. So you needed money to make money. You get the house, which is the product. You get all of the groundwork taken care of with the infrastructure, with the property manager, and you've never met the tenant, you know their name, and you get a check each month. So you're getting paid all this money, and then you take out the expenses, and then you make free cash flow. How does that feel?
Feels great. Yeah, it feels great. I think it feels great now. When I bought the house in October of 2021, and I didn't get a renter until mid-December. And so, it was only a month and a half, but it was kind of just sitting there. You're eating that cost. You're paying for your mortgage. It's a little unsettling until you get that renter in there, and then once you do, it feels great. But I think that's a big risk in single family. Any sort of investment vehicle in real estate is getting it leased up. I think for apartments or single family homes, it's never really about getting a tenant in there. You can always find someone to live. There's always a demand to live there. It's just what rate, right? And so I started out at $3,500 and then was lowering it like $100 every couple of weeks until I found a tenant at $3,000.
Fantastic. Well, you work in commercial real estate full-time with the bigger projects, and then on the side you do the residential. Why don't we finish here with your aspirations with real estate? Are you going to buy the whole market of Georgia, get all the houses, or how do you think about real estate going forward and the role you'll play in serving the market?
Yeah, it's a good question. So I do multifamily development. We build large infill, high-rise products, in primary markets.
A class.
Yeah, Class A, like the one we're sitting in now.
Yeah,
actually.
We're sitting in Class A right now.
Yeah, so I think going forward, I want to continue this path of single-family rentals. I think people call it mailbox money, but it's really, from a tax perspective, it's awesome being able to depreciate the value of the house. So you can depreciate it on 27.5 years, and so I can take like $15,000, $16,000 off my taxes each year. You've got a steady income, steady cash flow, you're building equity in the house. So I think there's a lot of positives. So I'm going to continue down that path. I'd like to get another house by the end of this year and then kind of just continue that path. It's really, $40,000 is definitely manageable. And then in real estate development, multifamily, I think that there's just continued demand for apartments. I think with how interest rates are moving up right now, and the lack of supply in the market for single family homes, I think people are just getting pushed into apartments, and you can see that. We're seeing it all over the country where rent growth is anywhere from 7 to 15%. So I don't see that slowing down. So I think the market for me is going to be primarily housing in real estate and continuing to push either single family rentals or multifamily.
If you guys enjoyed this video, hit the like button now. If we get 500 likes on this video, we're going to do part 2. I'll try and convince Park to want to do part 2. Let us know your questions in the comments and we'll make part 2 answering those if we get 500 likes. Subscribe now if you haven't already. See you guys in the next video.
Thanks, guys.